Unbiased Trading here, and today we're going to be doing how to create a setup using data part 2. So the first part of this part is main objective. So when it comes to identifying the main objective for a trading strategy, it is important to consider the following. As Mark Douglas explains, we simply need a larger probability of one thing happening over another. These can take several forms, such as a close red percentage, for example, for a short trade setup in small caps, or a higher probability of stocks closing green after consolidating for more than 2 hours. So this really can come in many different forms, and it really is dependent on your setup and what your idea is. But you need to kind of zoom out and see what is the overall goal for your setup, long, short, and based off of what kind of data point. Now, another alternative data you could use would be fundamentals. So your macro edge could be things like high valuations. So you could be identifying small cap stocks that are overvalued relative to their earnings, revenue, or other financial metrics. Or it could be the reverse, and it could be weak fundamentals. So identifying small caps that have weak fundamentals, such as low profitability, high debt, negative cash flow. Hopefully, dilution will be added to this in the future, but just currently, the dilution data is not very accessible, and there isn't like a really good API for it. But maybe if you're watching this in the future, it will be available and you can add that to your weak fundamentals. Now, this is where also a year of screen time comes into play. You simply need the experience and curiosity to test out concepts that you have seen play out in front of you several times. This is why I usually advocate for keeping a little notebook or log of new interesting ideas you hear about on Twitter, for example, or you see in the market over the week of trading. Then you can manually start recording samples of these ideas roughly for a month, or just do a 40 sample size. So just a small sample size, you can get the idea of if this particular process has a larger possibility of one thing happening over another. And if so, then you can start to run a comprehensive backtest over a longer period of time, such as 5 years. I wish I could be a bit less vague on this topic. However, it really does depend from setup to setup, from my experience. So if you do need more help, feel free to book a free call below while I'm still running it, and we can discuss whatever setup you're kind of interested in. Furthermore, after repeating this process a few times, you'll be able to look through a large dataset using a dashboard or another method to pull median statistics and find edges that simply appear from data. But for new users of data, most of the time you will need an idea because it's just 10 times easier to go off something you've seen rather than just on a large dataset. Hopefully, you're able to understand this part a bit better now, and we'll move on to entries and exits. Now, entries and exits, there's quite a lot of ways to determine them using historical data, but let's go through my most common ways of using it. One of the simplest and most straightforward approaches of using data to enter or exit is to use median percentages. Finding the median percent from open to high of day, for example, for a short setup from the previous 5 years of your current data set. Let's give a quick example. So let's assume it's 5% for this current data set, and you're going to enter short at 5% because on average, this is where most tickers have the high of day. Now, however, we must also consider the standard deviation to get a sense of how much this median can vary from ticker to ticker. As we know, we have black swans, we have things that move more, we have things that dump straight from open. So we also kind of expect a high standard deviation for this current statistic. So let's say it's 40%. We can use this information in two ways. We could use a very wide stop to allow such a big standard deviation of the high of day to still work for us. So ideally, we're aiming for like a high win rate here. Or we can go further into the data and uncover potential ways to narrow down the standard deviation while keeping the sample size above 150 ideally. Now, this could be through filtering different buckets, maybe a new data point so you filter even further, but be careful of overfitting and underfitting as I discussed in previous videos. Now, we might also investigate which tickers are in the top quantile band of this standard deviation to see if there's any patterns to why they had such a high open to high of day. Which could be really anything. It could be maybe the first 30 minutes volume being 10 times more than other tickers, or another data point in your dataset. Now, make sure to only use data points you can use before placing the trade, or a data point you can use to manage the trade real time, such as the evolving volume throughout the trade. Another important aspect of median percentages is determining and comprehending the opportunity cost of using a median percentage. Examine how many trades hit that median percentage and how many do not, and the effects of your historical equity curve if you've only used trades that hit or do not hit the median percentage. This will give you a better idea of whether it is better to wait for the median percentage or not to employ this method as an entry or exit method for your setup. Keep in mind what you are optimizing for, as testing these methods will not tell you which is correct and which is incorrect. It is really up to you to decide as a trader and what is better for you and easier for you to execute. One may reduce your P&L while increasing your drawdown, while lowering your drawdown, while the other raises your P&L and increases your drawdown, while the others increase your P&L and also increase your equity curve volatility. So there's always a caveat to each kind of method. I've never seen something that's like straight perfect. So it is really about deciding for yourself of what would be easier to execute and what you're more comfortable with. Now, another method for creating entries and exit signals is my personal favorite, which is time. Let me give you a quick example of this. If we did the same analysis on our dataset and clearly saw a high probability of a ticker closing green after consolidating at VWAP for 2 hours intraday, this could be a simple first step for us to know that we want to go long at VWAP if it's been holding for an hour to 2 hours. However, there's two aspects of this signal that need to be expanded on. First is, what was a consolidation for this dataset? In this dataset, a consolidation occurs when the price does not break a 5% range above or below the VWAP. Now, next part is, where would our stop be? So we might want to use the consolidation 5% below the VWAP because we're going long, or we could use another data point such as the number of times it breaks the relative low of that consolidation section. And if the odds are low for a ticker to break the low and still close green, we could use this as a stop placement, as this kind of shows us that the overall trade on a probability standpoint is going to be incorrect once it breaks through that low. So this is always these things you can consider when doing your entries and exits, as they will somewhat apply to your stops and targets as well. Most of the time, I found targets to be easier if you just use more long-term methods, so things maybe you're holding for an hour to 2 hours. I think scalping in small caps or even large caps to some extent is a lot harder to do on a database approach, I would say. It's surprisingly been a bit easier to do in futures, is what like my current model does. In futures, it kind of scalps. But at least for small caps, I think most of the time, if you're going to get the best returns, and even sometimes the smoothest equity curves, it's going to be like a longer kind of time frame exits, and your stops don't necessarily have to be tight, but I do always recommend going below 15% if possible, simply because you're going to get hit with a lot less halts, and there's a lot less troubles that come in with that. But yeah. So there will be more to come in soon, as I know this was a lot of info again on how to use data to make a setup for day trading. In the next part, I'll just be covering the idea of using more custom data points to create a setup and the ways we can go about using alternative data, such as the fundamentals. I hope to see you in the next part, and thank you for watching. And if you enjoyed it, please like and share with anyone else who might be interested. Also, make sure to follow me on Twitter, as I've been producing better quality over time right now, so I hope you enjoy it.